There's a number sitting in your mind right now. For most of your adult life, you believed that once you hit it, you'd finally feel secure, comfortable, maybe even wealthy. That number is $100,000. Your parents told you it was significant. Financial advisors used it as a milestone. The internet turned it into a goal. Once you hit 6 figures in savings, they said, you've made it. But here's what nobody is telling you in 2026. That number is a lie. Not because you failed, not because you didn't save hard enough, but because while you were grinding toward that milestone, the entire foundation of what money means shifted beneath your feet. Right now, in 2026, $100,000 in purchasing power is roughly equivalent to what $10,000 was in 2000. You're not broke, you're trapped. And the trap isn't what you think it is. My name is Julian Banks. What we're going to examine today isn't a recession. It's not a crash. It's something far more insidious, a ghost recession that only appears on the balance sheets of people who don't know where to look. We're going to break down 3 invisible forces reshaping wealth in 2026. The macro reality Wall Street won't advertise, the AI inflation shock your newsfeed is ignoring, and the quiet exodus of smart money into places you've never been invited. This is the blueprint.
Let's start with a question. If GDP growth is resilient, if the stock market is near all-time highs, if unemployment is stable, then why does it feel like you're falling behind? Because you are. And the reason why is hidden inside something economists are calling the labor pothole. Here's the invisible reality. In 2026, J.P. Morgan and Goldman Sachs are both reporting a 35% probability of recession in the United States. Not a guarantee, but a 1 in 3 chance. Now, you might be thinking, Julian, 35% isn't that high. That means there's a 65% chance we avoid recession entirely. True, but here's what that statistic conceals. This isn't a traditional recession where everyone suffers equally. This is a bifurcated economy, a 2-tier system. High-income households are thriving. They own assets. They benefit from market gains. They have access to private opportunities. Middle-income households, they're getting crushed. Let me show you the mechanics. Between 2023 and 2025, we experienced what economists call a level shock. Inflation spiked. Prices reset. Housing, insurance, transportation, all of them jumped to new plateaus. Then inflation stabilized. The media celebrated. Inflation is under control, they said. And technically, they're right. The rate of increase slowed. Inflation is now hovering around 3%. But here's the trap. Stabilization doesn't mean reversal. Prices didn't come back down, they just stopped going up as fast. That 2023-2025 level shock, it's permanent. Your rent didn't drop, your car insurance didn't drop, your grocery bill didn't drop. You're now living in a higher cost baseline forever. Think of it this way. Imagine you're climbing a mountain. For 2 years, the slope was steep. You were exhausted. Then the slope leveled off. You're no longer climbing as steeply, but you're also not going back down the mountain. You're stuck at a higher altitude, and the air is thinner up here. This is what's happening to purchasing power. In 2020, $100,000 could cover a down payment on a home in most suburban markets, fund a year of living expenses, and still leave a cushion. In 2026, that same $100,000 barely covers 8 months of expenses for a family of 4 in a mid-tier city. It's not that you have less money, it's that money buys less life. And here's where the ghost recession reveals itself. The labor pothole isn't about unemployment, it's about the squeeze. Middle-income earners are facing a triple threat: housing costs that reset 30 to 40% higher, insurance premiums climbing 20 to 25% year over year, and transportation expenses that never returned to pre-pandemic levels. High earners? They're fine. Their assets appreciated, their salaries kept pace, their stock portfolios absorbed the blow. But if you're middle income, you're running faster just to stay in the same place. The numbers say no recession, the data says resilient growth, but your bank account tells a different story. And the worst part? This isn't even the full story, because while you were adjusting to this new baseline, a second force arrived, one that most people don't even know exists yet.
Let's talk about the 2026 phenomenon nobody saw coming: AI-driven inflation. You've heard about artificial intelligence, you've seen ChatGPT, you've watched the hype around machine learning and automation. But what you haven't seen is the infrastructure cost. And that cost is being passed directly to you. Here's how it works. Meta, Microsoft, Google, Amazon, the companies we call hyperscalers, are in an arms race. They're building massive data centers to power AI models. These data centers require extraordinary amounts of energy. We're talking about facilities that consume as much power as a small city. Every query you make to an AI model, every recommendation algorithm, every automated service, it all runs on chips that generate heat and demand electricity. And someone has to pay for that power. You do. In 2026, energy and power costs are climbing, not because of oil shocks or geopolitical conflict, but because big tech is sucking up the grid. Utility companies are upgrading infrastructure. They're building new substations. They're laying new transmission lines. And every single one of those costs gets distributed across the customer base. Your electric bill isn't going up because you're using more electricity. It's going up because Microsoft needs to train GPT-7. This is creating a feedback loop. Central banks wanted to cut interest rates. They wanted to ease financial conditions and help the economy. But they can't, because this tech-driven demand is keeping inflation elevated. The rate-cutting cycle has ended before it even began. So, let's do the math, because this is where the wealth trap becomes crystal clear. Imagine you have $100,000 sitting in a high-yield savings account. You're earning 4.5% annually. That sounds decent, right? $100,000 times 4.5% equals $4,500 per year in interest. But inflation is running at 3%, so your real return is only 1.5%. $4,500 minus $3,000, inflation, equals $1,500 in real purchasing power gained. That's $125 a month. Now, subtract the rising cost of your utilities. Add 6 to 8% annual increases in energy driven by AI infrastructure demand. Subtract insurance premiums climbing 20%. Subtract transportation costs that refuse to normalize. Your $100,000 isn't growing. It's treading water at best. And here's the mathematical reality that changes everything. Because of the 5.5% fiscal deficit the United States is running, the government is pumping liquidity into the system. Tokenized cross-border payments are making capital flows faster than ever. Money moves at the speed of code now. But speed doesn't equal value. What this means is that liquidity is abundant, cash is everywhere, but purchasing power is under constant attack. Your $100,000 used to be a fortress. It was your emergency fund, your safety net, your ticket to opportunity. In 2026, it's dry powder. It's not wealth, it's ammunition. And if you're not deploying it strategically, it's evaporating in your hands. Let me show you what I mean with a concrete scenario. Family A has $100,000 in cash. Family B has $100,000 deployed across private credit, infrastructure debt, and alternative assets that yield 8 to 12%. After 1 year,
Family A is $100,000 plus $4,500 interest minus $3,000 inflation equals $101,500 real value. Family B is $100,000 plus $10,000 returns minus $3,000 inflation equals $107,000 real value. After 5 years, that gap becomes a chasm. Family A has roughly $107,500. Family B has $146,000. The same starting point, completely different destinations. And here's the reality. Family B isn't smarter. They're not taking wild risks. They're simply positioned where institutional money is flowing. Now, if you're finding value in this breakdown, I need you to do something. Hit that subscribe button, because what we're covering here, the invisible mechanics of wealth in 2026, this is the kind of intelligence that separates the builders from the bystanders. Let's keep going. Because while your $100,000 is losing ground in a savings account, smart money is moving, and they're moving into places you've probably never heard of.
There's a market that just crossed $1.5 trillion in permanent capital. You won't see it on CNBC. You won't find it in your brokerage app. But institutional investors, pension funds, endowments, family offices, they're flooding into it. It's called private credit. Here's what that means. Private credit is lending that happens outside the traditional banking system. It's mezzanine financing for mid-sized companies. It's infrastructure debt for renewable energy projects. It's senior secured loans to businesses that can't access public bond markets. And it pays. While public investment-grade bonds are yielding 4 to 5%, private credit deals are structured at 8 to 12%, sometimes higher. Why? Because there's less liquidity. You can't sell these positions on an exchange. You're locked in for 3, 5, sometimes 7 years. But here's the trade-off. You're getting paid for that illiquidity. You're collecting a premium that public markets simply don't offer anymore. Institutional investors understand this. They've been moving out of public bonds and into private credit for the last 3 years. The market has grown from $800 billion in 2020 to $1.5 trillion today. That's not a trend. That's a structural shift. And retail investors? Most of them don't even know this market exists. Now let's talk about the second migration. The 60-40 portfolio is dead. For decades, the standard advice was simple: 60% stocks, 40% bonds. When stocks fell, bonds would rise. When bonds fell, stocks would compensate. It was a beautiful hedge. That relationship broke in 2022, and in 2026, it's still broken. Why? Supply shocks, geopolitical fragmentation, tariffs, deglobalization. When supply chains are disrupted, both stocks and bonds suffer. Inflation stays elevated. Central banks can't cut rates. Risk assets and safe assets move in the same direction, down. Smart money recognize this. They're no longer relying on the 60-40 split. They're diversifying into alternative assets, private equity, real estate debt, commodities, infrastructure. These are assets that don't correlate directly with public equity or bond markets. They generate cash flow. They have inflation protection built in, and they're only accessible if you know where to look. This is the quiet exodus. While retail investors are still debating whether to buy the S&P 500 or a bond ETF, institutional capital is moving into private markets, and they're doing it for one reason: survival.
Let's bring this full circle. You started this video believing that $100,000 was a meaningful number, a symbol of financial security. Now you understand the truth. In 2026, $100,000 in a savings account is no longer rich, it's no longer comfortable, it's no longer even particularly safe. It's dry powder. But here's the shift that matters.
Once you accept that reality, once you stop treating cash as the destination and start treating it as the deployment mechanism, everything changes. This isn't about fear. This isn't about panic. This is about precision. The psychological advantage you gain from understanding these invisible forces is this. You stop playing defense. You stop hoping your savings will magically grow. You stop waiting for the right moment to invest. You realize that in a world of AI-driven inflation, fiscal deficits, and bifurcated growth, your money is either working or it's dying. And here's the beautiful part. You don't need to be an institution. You don't need to manage a billion-dollar fund. You don't need access to Goldman Sachs' private wealth division. You just need to think like they do. That means 3 things. 1. Stop measuring wealth by account balance. Start measuring it by cash flow and asset allocation. 2. Accept illiquidity as a feature, not a bug. The premium you earn from locking capital into private deals is the price of outperformance. 3. Diversify beyond public markets. Real estate debt, private credit funds, infrastructure, commodities. These are the asymmetries that protect purchasing power. The math is clear, the data is clear, the movement of smart money is clear. What's left is the decision. Are you going to keep treating $100,000 like it's 1995, or are you going to deploy it like it's 2026? Because here's the final truth. The wealth trap isn't the economy. It's not inflation. It's not even AI-driven energy costs. The wealth trap is the outdated belief system you're operating with. The belief that cash is king. The belief that saving alone will protect you. The belief that 6 figures in a bank account equals security. That belief system worked in a different era. Low inflation, stable interest rates, predictable growth. We're not in that era anymore. We're in the era of ghost recessions, permanent level shocks, bifurcated economies, and quiet capital migration. The only question is, are you going to adjust? If this video gave you clarity, subscribe, share it with someone who's still chasing outdated milestones, and leave a comment. Tell me where your $100,000 is positioned right now. Let's build this conversation. This is Julian Banks, and this is The Blueprint.